So over the last 3 years, borrowing capacity has been obliterated. Whatever you could borrow a few years ago is now dramatically less. For many people, this can be the difference between them buying a property and not getting into the market at all. So in this video, I'm going to go over 5 different strategies that you can use to increase the amount that you can borrow. One of the first things we need to understand before we get into the tips is, why are we even trying to maximize our borrowing capacity anyway? And for a lot of people, they maybe overestimate their financial position, and the banks actually go through your numbers and they're not that good. So a lot of the tips that I'm going to go through today are really just common sense things that you can do to present yourself as a low risk applicant. And if you like the video for any reason, just give it a like and make sure you subscribe if you haven't already. So tip number 1 is managing your debt. So if you have any kinds of bad debts, you will need to get them squared off, or at least reduced as soon as possible, if not completely wiping them. So stuff, especially the high interest debt. So stuff like Afterpay, like buy now, pay later. You've got stuff like car loans, personal loans. Maybe you've taken a personal loan for a holiday or to buy a boat or to buy something. All these little repayments that they see on your finances, that is going to look bad in their eyes. So if you can either clear them entirely or reduce them, that's going to help your borrowing capacity. So the second area that you can focus on is your expenses. A lot of lenders will use something called HEM, the household expenditure measure. And basically what that is a estimated expense level relative to your income and who you are. HEM can be quite controversial because, well, for many people, it's actually not representative of their real expenses, whether it's actually much more conservative than their real expenses are, or sometimes, like in my case, I had, they looked at my expected expenses using the HEM method, and they basically said that we're kind of basing our lending to you based on basically much higher expenses. You know, I'm relatively frugal. And especially at that time, before I got my family home loan, our expenses were very, very low. They were saying, no, we kind of are calculating it based on a higher amount. In some circumstances, you can, I guess, sort of argue this, but you have to show ideally a long-term amount of evidence that you do not spend at that level, or you do not have some of the things that may be included in their sort of average or their sort of expected HEM calculation. Area number 3 that we need to focus on is income. Now, for a lot of people, this is where you should actually focus 90% of your effort, because some of the other areas like expenses, once you've got your expenses under control for an extended period, there's not much more you can do. You've got low expenses, you need to move on to the next thing. One important thing to keep in mind with your income is that an extra $10,000 in income could be something like $40,000, $50,000, $60,000 in extra lending, depending on your circumstances. So it can add up quite quickly. If you get a new promotion where you're getting paid 20K more, 30K more, or you get a bonus, or you get this, you get that, it might be the difference between you borrowing an extra 100, 200,000 potentially, depending on how much you've added to your income. So really here what we need to look at is, firstly, you know, how can we increase your income? Now, there's a few different ways that you can do this. You could work on getting a pay rise at your existing job. You could start a business, do a side hustle, take on a second or a third job. You can do extra shifts or overtime at your job if that's available. You can work harder to get bonuses. You can work hard at developing new skills, ideally commercially valuable skills, that you can get paid more or be considered for a higher level role. Maybe you're learning leadership skills. You're already good at the technical role, but you're also learning leadership skills, so you have that combo to go into management. You can also look at broadening your skill set. So say for me, if I learned, I'm in marketing, I learned about Facebook ads, learning about Google ads gives me another feather in my cap and another way for me to earn income. You might also look at switching careers, doing a entirely different job, or working in a different industry, or working in a different role within your existing industry. Area number 4 that we need to focus on is credit score. Now, credit score is not as important and not as widely used as it is in America. However, don't be fooled. Your credit score can affect your application, only in a minor way, many brokers would argue. But for me, I definitely have had questions that I would need to go through with the broker as a result of the credit score. So I'll give you one example. I have quite a high credit score. I had to speak to the bank and they said I didn't pay $80 for some loan repayment. And what had happened was my repayment had changed, but the banking app didn't show that my repayment had changed. So I was paying the old repayment, and then there's actually it was a higher repayment or something, and I ended up being only $80 in arrears. And yeah, basically what happened was we just needed to address it and then update things accordingly. So even small things that seemingly wouldn't matter might matter to your application, or at the very least, it will cause a conversation about it with the bank or the broker. So you ideally want this all tidied up before you go to the bank. The main people are Illion, Experian, and Equifax. They're the kind of three main credit reporting agencies. Once every 3 months, you can check your score on their websites for free. But the important thing here is really your credit score should be a reflection of how good your financial habits are generally. Number 5 is to reduce your credit limit. So this is one thing that I did before we bought our family home. One of the things our broker made us do or asked us to do is to basically get rid of all your credit cards. We didn't really use them that much, but get rid of all the credit cards and reduce it down to one card and one small limit. So we had a card that had a 20K limit, another card that I think had 10 or 15. We got rid of one of them and we brought the other one down to only $3,000 limit, because I don't use the card and I wanted to, maximize my borrowing. By doing that, we're able to borrow a lot more, and that can be a very different situation to your actual reality. You might only be spending $1,000 here and there, and you have that high limit just in case you want to use it. But when it comes time to borrow some money, you want to make sure that is as low as possible. You can always move it up later if you want. I pretty much pay cash for everything, like with a Visa card or whatever it is. But I pay for everything with funds in the company. And for my personal stuff, I only have a personal $3,000 credit card. The final thing I would say is that how much you can borrow may not be consistent with the person that has the lowest rate. So when you hear your mortgage broker talk about it's not always just about the rate, borrowing capacity can make a massive difference. I'm not suggesting you do this, but there are many examples where people will go and pick a lender that lets them borrow a lot more money and gets them the property they need and maybe at a higher rate, and then refinance 6, 12, 18 months down the track and just cop the hit on the interest, because they're anticipating that, one, that property might have been a really, really good deal, or two, they're expecting it to go up by a greater amount than the extra interest they would have paid in that first 12 months or so before they refinance. That's something to keep in mind. Another thing to understand is understanding your own risk tolerance. Some people, they want to borrow the absolute limit of what they can get, which if you want to, that's fine. I've done that before. But the downside of that is if things go south, interest rates go up, you can be in a very different situation, even factoring in the APRA buffers for interest rates. They kind of allow for a little bit of a buffer for a few rate rises to see if you could still pay the repayments, even if they were quite a bit higher. For many people, it's gone beyond that. We had rates around 2, now they're around 6, and we had a buffer that a lot of banks will calculate of around 3. So some people are getting outside of that zone where the banks would be comfortable if they got a loan when they were much lower, and now in 2020, end of 2024, and going into 2025, they might be in a world of pain. So I hope you found that useful. If you liked the video, give it a like, and yeah, I'll see you on the next video.